Welcome everyone to Innovation Wednesdays. This is our first virtual version of Innovation Wednesdays. We have a few people here on the Zoom call, and we're going to record this and put it. It's going to live both on our website, but also at BonaTalks.com. Today we have Rich Maloy, and he is a 1997 Bonaventure grad, and he's going to tell us a little bit about his story and give us some tips that I think entrepreneurs, future entrepreneurs, and current entrepreneurs could use some of his experience. So instead of me telling about his story, I'm going to let Rich do that. So Rich, thank you for coming. Welcome.
Thanks. Yeah, thank you, Tom. Good to be here. And thank you, all the students and Todd for hosting me. I'm grateful that you would share with me some of your most precious resources, which is time. And so thank you for that, especially at 6 o'clock on a Wednesday night. As I mentioned, I'm a 97 grad. I graduated with a BBA in finance, and I went to New York City after college. I grew up in Pittsburgh, but New York was the only place that I wanted to go. I worked in corporate finance for my first career, specialized in analytics and reporting. My second career was in sales. Actually, through a weird series of steps, I ended up being in a enterprise resource program implementation manager. It was the most boring job ever, and I hated it. And I wanted to do a job where I earned based on the level of work that I did or the quality of work that I I so sales was for me. And so I actually did tech staffing sales for the next 7 years. And then I needed to get the heck out of New York. And I'd been in Manhattan for 14 years. I'd been in Midtown for 14 years and wanted a better quality of life. I wanted to get in the tech startup world. I didn't want to do it in New York. And I was definitely still, I think in some ways, am a stuck-up New Yorker about cities where, to me, there's New York City and then there's everything else. And so I couldn't go to another city. And so I wanted to go to a small town.
But I'll wait to do the quiz with you tomorrow.
And so I moved to Boulder, Colorado, and that was 2011. And Boulder's startup community was still pretty nascent. Techstars was just kind of coming online. Foundry Group was already there, and that's kind of the big name venture firm down here. Techstars was just starting to spin up. I think they only had 6 or 7 accelerators at that point. Startup Weekend was just getting rolling. Startup Weeks were just getting rolling. So it was an early time. I like to say that I filled practically every role in the startup community since then, from enthusiastic attendee to event organizer to community leader to sponsor, corporate sponsor, to early employee to founder. And now I'm fortunate with the 2 hats that I wear in my life. One is as a venture investor. So I'm a partner at a firm called Springtime Ventures. We're a very small seed stage fund here in Colorado, and we invest in high growth startups in secondary markets. And then the other hat is with a company called Startup of the Year. So the company is called Established, and we have a startup competition called Startup of the Year. But what Established does is that big organizations and big corporations pay us to help them find startups. And so our clients include NASA's iTech program, Air Force's innovation program called AFWorks, American Airlines, Silicon Valley Bank. We actually have a competition right now for veteran-led startups that we're pretty excited about as well. So I spend 100% of my time working with early stage startups, and I have worked with early stage startups for the last 8-9 years now, and that has been solidly been my third career. And it's amazing that you are all getting started with your entrepreneurial journey, at this time at St. Bonaventure, and being able to do it in a way where you're surrounded by resources and education, but then also not knowing what all the resources are that are out there. And so I'd like to share some of those with you. And I'd also like to just take a few minutes to just share a couple of gotchas that I see happen way too often And I actually have a little, I'm going to run through a deck really quick. I know we didn't plan on this, but this is a presentation that I give. And so let me just do a quick screen share. This is a presentation that I give pretty regularly called Pitfalls to Avoid When Going from 0 to 1. And Peter Thiel, love him or hate him or whatever, but he wrote a great book called 0 to 1, and talking about the hardest thing is to go from 0 to 1. That is from idea, nothing, to just one thing. From 0 customers to just 1 customer. From 0 products to just 1 product. And so these are some of the major things that I see. And again, I'm just going to run through this really, really quickly. So this is not as relevant for you all because you're students, but I want to share with you a quick story. I worked for a guy that risked it all. He quit his high-paying, high-profile, globe-trotting management consulting job, multiple six-figure income to start his startup. And he even sold his dream home and moved his family, 4 kids, he and his wife, so 6 of them, moving from a bigger home into a smaller home that they were all crammed into in order to get some additional equity to build and grow that business. And he made every mistake in the book, ran out of money, and had to go back to consulting. I worked for him, not at his startup, but at the consulting company he founded after that. And so this is you know, the sad part is that you hear these stories in the media about the founder that risked it all, like Tony Hsieh, who founded Zappos, right? He literally risked it all, put it all in line, went all in on Zappos, and he was successful. And we celebrate that story, but that is the rare example. The more common scenario is that I meet founders that are putting it all on the line, or have put it all on the line and have lost it all. And so you should never ever. My advice to you would be never ever put your well-being, and in the future your family's well-being, your financial security at risk. You know, you always have to make sure that you've got some soft landing available for you. So a little less relevant, but it's actually very relevant because the last time I gave this talk was a month ago, and a woman was about to take out a second mortgage in order to finance the development of her startup, and we were begging her to not do that. And thankfully she didn't. And so she's in a much better situation, especially now. So again, established VP of Engagement, Springtime Ventures venture partner there. Those are my email addresses, and I'll share this with you guys as well. Tom, I'll drop this into Slack, and you can share it with the team. So the second most question I get is, how do I find a CTO? How do I write code, you know, to build my startup? But the pitfall is actually writing code first. Right? The first step is to get out of the building and talk to potential customers. So you should never be writing code, or even, you know, and the second pitfall is paying somebody. The worst thing to do is to pay somebody to write code for you. Right? Paying for development has its place, but only later. What you should actually be doing are 3 things. Number 1, this is before you write a single line of code. Number 1, talk to customers. Number 2, Wizard of Oz. And number 3, get out into the community. Right? So talking to customers just basically means running your own accelerator. And you're probably getting a lot of this with the work that you're doing already. A couple of resources for you. Eric Rees, The Lean Startup, is a good resource. Personally, I like Ash Murray's work with the Lean Stack. And he has tons of free resources there at leanstack.com. And he took a version of the business model canvas and dialed it in specifically for early stage startups. And so I just love the lean canvas as opposed to the business model canvas. It's just a different flavor of the same thing. But this is something you can do before you write a single line of code. I use Lean Stack all the time. I use it even internally. We're going to start doing some more live streaming. And as I'm thinking through what is the business model for established when we go from in-person events to online events, boom, open up Lean Stack, create a couple canvases, think about those sorts of things. Solution-focused interviews. I'm going to skip over this. Let's talk about the Wizard of Oz. We at Springtime, we got this pitch from this company called Car Body Lab, and they built an entire business. They were somewhere in the tens of thousands of dollars of monthly recurring revenue in their business without writing a single line of code. This is how they did it. First, they built a website. Okay, easy enough. Tons of places to do that. Next, they found one of those mobile app builder sites, right? And so they could port their website and have an app that did what they needed, what they needed to do. Then they started collecting data, and then they just had forms. So what it was, what the business was, is that you could, they would connect you with somebody that would, if you had a ding in your car, that person would come to your house and fix the ding, right? So you need to fill out a form, you know, the customer needs to fill out a form and take a picture and upload pictures and whatever. All that stuff you could just collect in any sort of form builder. Collected all this information on forms. On the other side was a community of a marketplace of people that would come and do this work. And then they were just making those connections back and forth. So then they need to accept payments. So then they hook up Stripe to payments. All right, no problem. And then they want to start automating some of this communication back and forth. Well, this website, close.com, has automated CRM-based communication. And then they needed to start booking appointments that tied into automated communication and tied into the Stripe payments that tied into the Google Sheets. Well, Checkfront managed all of that. And then they wanted to strengthen that community. So they just made a Facebook group. And then they want to start a newsletter. And so then they started a newsletter on SendGrid. They did all of this, $10,000, $20,000 a month of recurring revenue, not a single line of code. It was all just Wizard of Oz, right? Pay no attention to the man behind the curtain, right? Just pulling levers. Didn't have to write a single piece of code. And so this link here, soty.link/no-code, is a buddy of mine that wrote a good little Medium blog post about no-code resources and places that you can go to find some good resources. Oh, and lastly, I forgot to mention this. Zapier is like magic. Zapier is a tool to integrate all of these things and have them all talking to each other. So Zapier is a great resource for all of that as well. Another great thing for Wizard of Ozing and for figuring out these things is the book Value Proposition Design. This is from Strategizer. They're one of the leaders in the leading consulting companies in the lean startup methodologies. I really like this book better than all of their other ones. Okay, next thing, community, right? The third thing that you should be doing before you write a single line of code is being out in the community. And this is especially relevant here. This is Rich's entrepreneurship class. And so Todd, I would never get a job at Bonaventure because my class for teaching entrepreneurship will be this. Day one, I drain your bank account and max out your credit cards. Now you have no money. Welcome to being an entrepreneur. Day 2 through finals, you want money, you pitch. Whether you pitch for $5 to get a beer, or for $500 to get a Chromebook, or $5,000 to pay your rent and your living expenses for the next quarter or month or whatever, right? You have to pitch. As a founder, as an entrepreneur, you will always be pitching. A buddy of mine has a website called obvioustartupadvice.com, and he has some great posts on there. The one that I like the most is that a CEO has 3 jobs. Job number 1 is sell the vision. Job number 2 is attract the best talent. And job number 3 is never run out of money. All 3 of those things require you as a CEO to always be pitching. So when you're selling the vision, you're pitching. When you're attracting the best talent, you're pitching. And when you're never running out of money, you're either getting customers or you're getting investors. Both of those require pitching. So learn to pitch. And I know that you're already working on that. And then lastly, tons of community resources are out there. Take advantage of them. I'm happy to be here. I'm going to start doing online office hours. I will drop it in the Slack channel so that if you have specific questions, if you want to come and join me for office hours, I'd be happy to host you for that. But look for the office hours and the things that are out there, and the startup events and the pitch events and the meetups and all those things that are out there for you. Here's another link for more free stuff that you can go in and get access to. And last tip is that co-founders come from community. More often than not, when I hear co-founders talking about their stories, very often they're telling them how they met each other through the community. And then here's 2 major pitfalls. So we're going to shift gears here again. I'm flying through this really quickly so that we've got time for some more interaction and to hear your pitches and stuff. But two quick things that I want to make sure that you're checking the boxes on as far as the organization goes, right? So number one are founder agreements. If you're going to start a business and you're going to have co-founders, you have to have your founder agreements in writing. Even if it's just an email, hey, you get 51% and I get 49% because of this or that, or we each get 50% or whatever. Even just an email, you have to have this in writing. I could tell you story after story about how many times I've seen this sink startups, and some very juicy stories as well. So we'll save that for burgers at the Burton when that reopens. But in two terms here, vesting with Cliff. If that doesn't mean anything for you, I'll give you a quick rundown on that. Vesting just means that you don't get all of your ownership up front, and all founders should be doing this for yourself and for your co-founders. It just means that let's say that I get 50% of the company. Let's put that on a 4-year vest, or let's make it math easy for me. Let's put that on a 5-year vesting cycle, right? And so then I only get, after year 1, I only have 10% of the company. And after year 2, I only have 20%, so on and so forth. And if I leave at any point during that vesting period, I only get what has already been vested to me, what has already been given to me. And what a cliff means is that you get nothing up until your cliff. And then at your cliff date, which will be usually is 12 months out, then you get everything from that cliff period. So you basically are at 0% ownership until you hit your cliff date. And so a 4-year vesting with a 1-year cliff is very standard. I'll give you a great example. I joined a startup and it was not a good fit. And they did not have a cliff. I was only there for 6-7 months, and they still had to give me equity because I had vested during those 6 or 7 months. And so it was a loss. It was a complete waste of equity for that business. So founder agreements, get it in writing, keep it simple, and do vesting with a cliff. Last thing is that LLC versus a C Corp. It's fine to be an LLC. LLC for the win for starters. If you want to raise venture capital, if you want to raise institutional money, you will have to be a C Corp, but you don't have to do that now. So down the line, you will have to be a C Corp. Pitfall, no founder agreement that I mentioned, not having founder agreements being a pitfall. And this last piece is just about my talk on the psychology of fundraising, is that there's a lot of psychology around fundraising. But we don't have to get into that. I think I'll stop the screen share. I've just vomited a ton of information at you. So Tom, what should we cover from here?
Sure. I mean, that was amazing, and thank you for preparing that ahead of time. And I have a couple questions that may kick off a conversation. And so you mentioned the sort of 3 reasons, the 3 responsibilities of the founder.
Yeah.
And they're all 3 of them pitching, whether it's selling your vision, attracting talent, and never running out of money.
Yep. And
I think one of the word that comes to my mind is sales. So pitching is sales at some level. Is there, in your experience, can you talk a little bit about the founders and the correlation between them and sales in general? Yeah, maybe there's some stories or something that you have.
Yeah, I've actually seen far more founders that are not salespeople than I have salespeople that are founders, right? Some of that may be that if you're a salesperson, you're motivated by the amount of money that you can make. That's how the business, that's how that 80% of that works. And so, if you are starting a business, you're motivated by other things. If you're an entrepreneur, you're motivated by bringing something to life, building your business, taking it to market, solving that particular problem. And so more often than not, the founders that you meet are not salespeople. And so it's not, you don't need to have this whole, arsenal of sales tools that you need to use. You just need to have a basic understanding of it's your job to pitch. It's your job to sell the vision. It's your job to get people on board, to convince them that what you're doing is important, that the pain is real, and that you're the right team to do it. And it doesn't have to be salesy. I would say there's actually not a strong correlation between salespeople and founders.
Awesome. This is kind of going back to.
I'll add one other, Tom, I'll add one
Yeah.
other point there. Sorry, that is the passion that you have for solving the problem that you're solving comes out naturally. So if you're motivated by your passion, talk about your why. Why are you doing this? Right? And that'll drive the conversation. And that, speaking from a place of passion, will be far more effective than just trying to sell somebody.
Yeah. So that kind of is a good segue into my next question. So you're a seed stage investor. Can you explain what that means? Number one, and number two, what are the features, or what are the things that you're really looking at for the investments that you're making?
Yeah, absolutely. So the venture capital world is funny, and I don't know how what your level, what everybody's level of expertise is with it. Not you, Tom, but the students here. So the venture world groups investments into series, and so a Series A used to be the very first institutional money that a high growth startup would receive, right? And so you would get a Series A investor. They used to be the earliest stage investors, and then there are Series B, Series C, Series D. The series just keep going. All that represents is just that the Series A investors invested here, and then everybody else invests after that. And so that just indicates the tranche of investment that was made. Now, as the venture market started to mature, and it became less expensive to start businesses. So what it cost to start a startup in 1999 was it maybe cost $50 million to get web servers, right? And now you just go on.
Well, your example is the perfect example of the Wizard of Oz approach, right?
Right, totally. Nothing, it costs them nothing, right? Except whatever they pay in SaaS fees. So the seed stage is the predecessor, or precedes the Series A investment, and so that is the earliest stage. And now what's even happening is the seed stage is lengthening, and so now when I tell startups, I say we tend to invest at late seed, right? And so now we see startups that are maybe raising $500,000, and that's an early seed round. And then we see other startups that are raising a seed round of $2 million, and that's definitely a late seed round, right? And so all that does is that just represents that really, really early stage of company.
Got it. So I mean, is there a typical founder, or what's the perfect scenario? What are there skill sets that you're looking for? Like, can you talk, dig into some of that?
Yeah.
Who somebody walks in, is there something that's just like, oh yeah, I want to hear more?
Yeah. So we, like most venture firms, Springtime has a thesis. And so our thesis has 3 legs to it, right? So it's founders with deep domain expertise in core industries in America with truly transformative technology, right? And so the first one actually keeps us away from investing in first-time or in young founders, right? So this is an interesting piece, right? We looked at a telemedicine veterinary company in the early fall last year, and it was 2 kids that were in their 20s, early 20s, and they were like 2 or 3 years out of school, and we just couldn't get comfortable with investing in them. And now obviously their phone is ringing off the hook. They're signing up 100 customers a day, 100 vets a day. They're working 20 hours a week, trying to keep up with the amount of business they have. And they have Series A investors beating down their door saying, can we invest in you, right? We miss that because we don't invest in first time, 20 something founders, right? So that's just our perspective. Other people have different perspectives. At Establish and at Startup of the Year, we love early stage founders. There's a founder that has an AP tutoring, live stream AP tutoring for high school students that she does. And she runs it totally bootstrapped. She is super scrappy and highly passionate and motivated about what she does. And I'm supporting her every way we can. We're trying to invest in her through through another vehicle at investment vehicle at Established. So anyway, my point there was to you students, don't get discouraged just because Springtime doesn't, invest in first-time founders. Everybody has different perspectives on the market. But the way that the venture capital works is that as a venture investor, the way that we make our money is when a startup has an exit. When a startup sells to a bigger company or has an IPO or goes public, lists on one of the stock exchanges, right? And so we're only making our money when you exit, and that could be 5 years, it could be 10 years. One of my partners at Springtime had a venture fund, and their last fund was vintage 1999. They deployed about $300 million worth of capital inside of 2 years, which is bananas. I mean, it's crazy. They were just spending money like crazy, but that was 1999. And they just sold off their last business 17 years later, and they just wrapped everything up in 2017. So it can take a long time for a venture investor to get their money out. So, that's a very specific use for venture investment.
For seed stage, so the seed stage investing that you are doing, can you talk about the size checks that you're writing and where that is in sort of how much these companies are raising?
Yep, absolutely. Yeah, so we're seeing seed rounds right now anywhere from $500,000 to $1.5 million. And so that's a total amount of money that the startup is raising. That never comes at the seed stage. That never comes from just one investor. And so the nice thing about the seed stage venture market is that it's very collaborative. And so we all want to make sure that we're all seeing each other's deals so that when we write a check, we know that they have enough money that we call that runway, that they've got enough runway, that they can run for 12 to 18. Now we're looking for 18 to 24 months of runway. And so for Springtime, we write, our initial check is 130,000. It's a weird number, I know, but for whatever reason, that's our initial check size. There's math behind that, but I won't get into it. But so we write 130K as our initial check. And then we also have 40% of our fund reserved for follow-on. And what follow-on means is when that Series A round comes around, we want to continue to invest in a certain number of our companies. And so we'll invest more. So if we're investing $130,000 into $1 million raise, we're not a significant investor. And so typically a lead investor will write anywhere from 200 to 500K checks for those rounds.
So in those, what is the valuation of those companies? Normal? Is there like a general range?
Totally. Yeah, absolutely. And this is all outside of Silicon Valley, right? Silicon Valley is its own world, weird world. We don't play there. But in normal people land, in normal world, a typical valuation on say a $500,000 raise is probably, 4 to 5 million pre-money valuation. And on on a bigger raise, we've done as high as 10, 11 pre. So I would say that is the top end of the seed stage pre-money valuation right now is in the 10 to 12 million. And I would expect that to come down over the next 6 months.
Yeah. So is what you're saying is a company might raise $1 million and they're valuing their business at a $4 million. So they're selling off 25% of their company or 20% of their company.
Yeah, in that case, I think it would be 20%. But
yeah, 20% of their company.
Yeah.
So they would have $1 million in cash and they'd have $4 million in the rest of the valuation, right?
Yep.
And you would own basically 130,000 of that $1 million, right?
Yeah, and so you just take. The simple way is you take the post money, right? So 5 million post money, And if we invest 130,000, oops, I did that backwards. But then we would own, 2%, 2.6%. Actually, that's
Yeah.
incorrect. So we'd own 2.6% of that company.
Okay. So thanks for that sort of that like VC lesson, I guess, for lack of a better way to say that. Any other? So you talked a little bit about community and people finding their founders in the community. You live in Boulder now, correct?
Yep.
And you're obviously very familiar with Bonaventure and Western New York and whatnot. First of all, where are you from?
Pittsburgh originally.
What's that?
Pittsburgh.
So if you're a student, for example, at a school, where is there places that they should be looking for co-founders?
You should be looking to your fellow students for sure, right? Yeah, and the other place, if you wanted to look online, I don't know if it still does, but AngelList used to have a great, very active job board for startups, and you could actually post jobs on AngelList that were equity only. And you can't do that most places, and so you can post free job posts on AngelList specific for startups. So you can look there. Look to the industry community that you're in, right? And so if you are selling to, if you're selling to, we looked at a company that sells to commercial cleaning services. Right? And he was from that world, right? But he didn't have any founders from that world. So he looked in that world, and as he started to expand his network, he started to meet people in adjacent industries and find additional people that he could hire from, say, the commercial real estate world. So look into the industries that where you're trying to target your solution. But the most thing is, the biggest thing is that people also have to know that you're looking for a co-founder. And so you never know unless you ask.
Right. So one of the things that are that we're always looking for is a way to find our target customers, really, both to identify them, but also to dig in and discover their problems. Is that, so you're in Boulder, some of the companies that are growing out of Boulder, their target customers aren't necessarily there.
Yeah.
Do you have any experience shares around that concept of finding your target customers who aren't necessarily in person? I mean, now that we're all in a Zoom world.
Yeah. It should hopefully be easier now that we're all in a Zoom world. I would say that you have to expand your network, and networking as a student, I think that is it's a severely underutilized skill for students. I'll tell you, I lived in New York for 14 years. I had 2 Bonaventure students reach out to me in 14 years, right? I've had 0 reach out to me in Colorado. I take that back. I had 1 because his aunt, who I know in Boulder, said, "Will you talk to my son because I see that you went to St. Bonaventure," or my nephew, "Will you talk to my nephew because I see that you went to St. Bonaventure," right? So that wasn't even him leading. So you students, I'm talking to you now, right? There's an alumni network. They are untapped. They are not hearing from Bonaventure students. They want to hear from Bonaventure students. I want to hear from Bonaventure students. I feel like I practically forced this kid to talk to me because I was like, "Yeah, wow, somebody from Bonaventure, let's talk," right? So tap into that resource. Go find that alumni directory and use it in cold email. And I'll tell you, in 1997, as I was job hunting in '97, I did this, and I went to the alumni office and I looked up the alumni and I looked up everybody in New York City and I wrote them letters because that's what you did in '97. And that is how I got my first job, was through somebody from Bonaventure that introduced me to somebody else and introduced me to somebody else. So build that network and ask for those referrals. Those people are out there and they want to help you. And so you never know unless you ask.
Awesome. So I want to open it up to anybody that has questions. I know Jason Green, you mentioned you have a question. Anybody else, feel free to jump in. Jason, why don't you get us started?
Rebecca has a question too. Okay, when Jason's through.
So the question I had was like running a company in an economic downturn, right? Like a lot of companies are going under, laying off. So if you're like starting a company and you're looking at like target markets, how do you try to find like a brand yourself towards like a market necessity, right? Something that's going to be needed, even in, because there's a lot of companies that can prop up on a good economic market, and then when it goes to a bear market, there's companies that are laying off. So how do you make sure that your company and your customer base is a necessity versus a kind of a luxury, so to speak?
Yeah, and are you asking how do you make sure that your customer base is a necessity, or how that your solution is?
Kind of maybe not customer base, but more of like your company focus. Does that make sense?
Yes.
Right? Like the example I kind of use is like in World War II, Coca-Cola sold like 5 billion bottles because they marketed themselves as like part of home, right? Like, so if you're a company like right now, what would be like good steps to go towards that? Maybe, I don't know.
Yeah. Yeah. And first, that's a great insight, right? And that's something that we're taking an extra hard look at right now at springtime with every company that we're looking at is how core is this to the business? How absolutely essential is this? And I think we've made some investments that are maybe not essential in our previous investments, because like you said, good economy can prop up any sort of business. I think that when you come down to it, this is my perspective, but my perspective is always that convincing people that you are going to save them money, you have to save them a lot of money for them to care about it. And so when somebody says we save 10% costs, who cares, right? It's going to cost me, it's going to cost me as a business 3 times that to implement it, right? But if you can cut my cost in half, now I'm listening. So cost saving to me, this logic may seem backwards, but to me, it always seems like cost saving is a harder sell than making money. How are you going to drive my top line growth, right? And and so again, I'm just one person, just one perspective, but that is one of the things that I think about is there a value proposition that they're making more money for the company, or that they're saving the company money? And then if they are saving money, how much are they saving them? So then the next thing is to just ask good non-leading questions when you're doing customer discovery. And I kind of skipped over this in my talk, but a good customer discovery call, you're not leading the witness. You are really digging in on what is the pain point and why is that painful. And you're not leading with like, I've got this great solution, let me tell you about it. You're just really digging in on the problem.
Okay, thank you.
Rebecca, you have a question?
Yeah. Hey, Rich. So something that I've really been learning this year, and kind of something we focus on the center, are like relying on your values to make decisions. So kind of question I have for you are there any values that you really rely on to help you make decisions in both like your professional life, like deciding on to invest in a business, or even in your personal life, like when you decide to switch careers or move out to Boulder? Like, are there any values that you really relied on where you've either decided, I'm really not going to invest in this business, or, this is the right choice just because they kind of aligned with that? So if you can kind of just, offer any insight on that, I'd really appreciate it.
Yeah, thank you. And, I appreciate the values that the Innovation Center puts forward, Tom, and all the work that you're doing. So I love to see that. Me personally, I have five core values. I have a personal mission and I have 5 values. And so my values are communication, consistency, and accountability. And I've had those 3 values for a long time. When I moved out to Boulder, I was so inspired by the community here that I added openness and inclusiveness to my values. And so that drives me a lot, right? And I think a lot about that to me, the communication, consistency, and accountability is a pyramid, and they build on top of each other. And then they're surrounded by this idea of openness and inclusiveness. And so one of the reasons I joined Established, and one of the things I always loved about Established, I used to sponsor the Startup of the Year program when I was at IBM and at SoftLayer, was that they were better at founder diversity than anybody else, and way before founder diversity was cool, right? So they were, so they always made sure that they had great female and minority founder representation for years and years. So I always appreciated that aspect about them. As far as decision making goes, I'll tell you, every investor will tell you that they've got the no asshole rule, right? And we invested in a startup that the founder or the founder CEO, right before we wrote the check, bit off, it really bit back at me on email in a pretty nasty way. And we had a very serious conversation as a team as to whether or not we wanted to continue to invest in that person. I was like, yeah, look, he is a divisive person, and you either take him or you leave him. And he turned out to be a terrible CEO, and because of that divisiveness, right? And so we learned a lesson that we did invest in an asshole, and it turned out to be a bad thing. We try to learn from those mistakes. Did that answer all of your question? Did you have more? Was there more to that?
No, that actually answered it. Thank you so much. I really appreciate it.
Pleasure.
Rich, can you talk for a second about what made you come up with those values and think about them just in general?
Sure. Yeah.
I don't know if everybody has values that they can list off like you did.
Yeah. A lot of reflection and some work as well. So I've found that a lot of conflict and problems can be traced back to not having good communication from the outset, right? And so if I don't tell you what I'm expecting of you, then you have no way of knowing. And if I'm not clear in my communication, and vice versa, right? And if I'm not communicating with you about something that happened, and I took it this way, and when you said this, it made me feel like this, and doing it in having some of those frameworks that are really good for having that healthy communication, it just makes it easier to be a human being, to just constantly be working on your communication. And so communication to me is a core of all of that, right? And then the next piece is consistency. And so when I behave and this came from having bad bosses that were highly inconsistent, and everything goes this way this day, and everything goes this way this day, and then it's always forward, and then it's all back. And that was so infuriating that I started thinking about how that affected me and how I wanted to be in the world. And I didn't want to have this craziness all, swirling vortex of craziness around me, that I wanted to be able to provide a consistent environment for colleagues and for bosses and for employees and subordinates. So, and then the last piece, the accountability, actually came from a client of mine. And that was one of his values, was accountability. And for him, it was, and for me as well, and I adopted this from him, was that accountability starts here, right? I have to hold myself accountable first. And so if I'm clearly communicating and I'm behaving in a consistent manner, then I'm holding myself accountable for those things. And only after I've held myself accountable can I hold you accountable. And so accountability actually starts here. And so I had those, I formed those actually from many years being in New York. And then when I came out to Boulder, also in 2013, I had a bad experience with a prominent community leader out here. He basically stabbed me in the back in a very public manner, and I was so angry about it. And because he's this person that the community held up as like one of the great community leaders, and I was like, this guy's an asshole. And I found out that other people had the same feelings, and I was like, okay, what is it about that I thought was awful, and how do I want to be in the world to the community that I'm in, right? And openness was one of the things that he took advantage of, my openness. And I realized that I can't, even though that person took advantage of that openness from me, I couldn't shut that down, that's how I wanted to be. And, I just need to be maybe more cognizant of that was bad. That person was a bad actor. So I realized that openness was actually something that I really wanted to double down on. And then that inclusiveness in that wanted that this community, one of the things I think made Boulder special and makes Boulder special is that when you come to Boulder, we want everybody to feel welcome. And so, particularly in the startup community. And so I added those two pieces in.
That's awesome. Thank you. Dr. Palmer, did you have a question before we have to close it down?
Well, first of all, I want to say this, Rich, I really like what your points tonight were so wonderful. A couple things I really called though was one of the Wizard of Oz. And it's really important for our students to understand is that you can be part of the tech world without being a coder. Yeah. And that your ability to go out there and investigate all these incredible programs that a lot of people don't even think about, know about, and piercing them together really give you an advantage in creating products that you can put online and sell different ways. So to me, that's one of the many lessons I got. Now, my bigger thing is here, and I love the other thing you said too, about you're always pitching. You're always pitching. So these guys here are going to be pitching over the next few weeks, doing a lot of pitching. So would you tell us a little bit about what you see as a good pitch and what you see as a bad pitch, and how would you distinguish those?
Sure, yeah. Let's see here. Bad pitches, you have more words on your slide than you're talking about, right? So don't read your slides. In fact, Guy Kawasaki has the rule called the 10-20-30 rule, right? So no more than 10 slides, no more than 20 minutes, and no font smaller than 30-point font. And that's his rule, and that's his rule for like pitching when you've got a VC meeting or something like that, but or even for a presentation. So keep the 10-20-30 in mind, right? Simplify, and remember that the people that you're pitching are only going to remember one thing. So what's the one thing that you want them to remember? And so this is, this constantly come back to condense that message, simplify that message. What's the one thing that you want people to remember? The next thing that I would add is that a great format for pitching when you're first getting started is to frame the problem in a story. So meet Tom. Tom is Tom is an entrepreneur, and Tom recently moved, back home, and this is what Tom is doing, and Tom has this problem, and Tom has, a loud siren outside of his house. Well, here's why that is a problem for Tom, and here's the solution, and why our solution of Rich's earmuffs solved Tom's problem, right? And so you tell the story about the problem and the solution in a story about a person that's not you, and it's even better if that person is an actual customer. So that's a pretty standard format that I see a lot of.
Awesome. Well, Rich, I think the thing that comes to my mind is to just thank you for really adhering to your fourth core value, openness, and being open for us and sharing your story and some of these tips. I appreciate that. I know we all do. And yeah, thank you for coming. Thanks for being here. Yeah. It sounds like Claire has one last question. Do I see a hand?
Oh God, no, sorry.
No,
I could come up with one though.
Well, I know we have a hard stop right around now, so I appreciate it, and thank you. I appreciate it, Rich.
Absolutely, thank you all. Yeah, good work, Tom. Todd, thanks for organizing this and getting this off the ground. And I'll be in the Slack channel. Let me know how I can be of service to you all.
Great.
Thank you so much.
Awesome.
Great. Thank you.
Thanks, Rich.
Hey,
thank you so much.
Wait, Rich.